This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty with the Market Guys, and welcome to our open house Q&A session, where I'll be highlighting the rapid fire stock analysis segment, as I always do. And before I get into the rapid fire stock analysis, which is where I take your stock symbols and analyze them, I like to go over some of the market data as a overview to what we're seeing on the charts. Now, this is a one-year daily candle chart of the SPDRs, which is the S&P 500 ETF, and I've left my lines on the chart from last week's weekly market report. And if I may just again welcome the brand new followers from the TradeStation crowd. Those of you who were on the webinar that I did a couple of weeks ago as a three-part series, welcome. This is something that I do. If you go to the Market Guys website, you can subscribe to the weekly market report, and I go through my analysis. Now, last week was the first week that I was not 100% accurate. So I broke a 33-week winning streak where for 33 weeks in a row I was 100% accurate. What I mean by that is 100% of the trends that I forecasted for all of the major indices. That's the SPDRs, the Diamonds, the Russell 2000, the Qs. I do that every week. I was 100% right on all of those indices for 33 weeks in a row. And I think what happened and what threw us off that this 1 week was the presidential elections. I think we're in a season of surprises all around. So I think the thing that we can count on is that we can't count on anything here, especially towards the end of the year. So this is going to be for an interesting end of 2016 as we go and look at what we're seeing here on the charts. This, again, is the SPDRs. And if you look very carefully, I want you to notice what's happening here at the very bottom of the chart. These are the volume bars. And today we broke over the resistance line that I had set last week. Even though my forecast for the end of this week is going to be lower, we did break over that resistance line, but we did that on lower volume. So whenever you see a drop in volume on a breakout or a drop in volume on the way up, you can't always say that, oh, we're going to continue up, because the drop in volume tells us that the buyers are getting tired. I will say that probably every single time I talk about a stock, I'm going to be talking about the volume and comparing that to price action. Please do yourself a very big favor and make sure you're doing the same thing whenever you're analyzing a stock. By the way, I see some people putting in stock symbols. Don't put those in yet. David, what we'll do is when I ask for the stock symbols, we'll take one stock at a time, and then if you could tell me what your intentions are with the stock, whether you own it, you're thinking about buying it, or whether you think about selling it. Let me know when we get to that part of the program here today. Okay, so that's the SPDRs, and keep in mind, if you could see my cursor down here, this is a gap that is still open, and we have almost a vertical price move here in the S&P 500 on a drop in volume with a gap below the market. What that means is don't get too excited about taking a major position on the long side. You have to be very cautious. If you do decide to buy, let's say you buy the SPDRs because you think the stock is breaking out, you have to keep very, very tight stops, because if you take a long position and it starts coming back down and you don't have a stop set in place, that could be a very painful experience, because this market can actually drop faster then it's gone up. And that's just the rule of the markets. Prices always drop faster than they go up. And a lot of that is driven by the fear emotion. So when people start selling, it's usually a sell action brought about by fear or a concern of losing money or losing their profits. Okay, so that's the spiders. Let's take a look at a more broad-based index. This is a Russell 2000. Check this out. Look at this. Again, this was my forecast for from last week. The end of my trend line is where we wound up today. We closed, again, within pennies of this vertical trend. We came within pennies of the end of that line. Let me show you. I'll zoom in here. Look at that. Remember, this line was drawn last week. And if you notice, the end of my line is right where we closed today, probably within 2 pennies of that line. So now I'm expecting this pullback. One of the things that I mentioned last week, and I'll mention this again, is we now have, I think this is 13 green candles in a row. 13 green candles in a row. What does that mean? We're long overdue for a red candle. Who can tell me, who's one of the regular Market Guy followers, who can tell me what the stretch of red candles is called? What's that? What's the term? Yes, Stuart, you're absolutely right. First to answer, a stale green light. And yeah, look at Craig, Charles, and Larry all right in there. A stale green light means that eventually we're going to see a red light come up soon, or a red candle. So if you have any stocks that are following any of these indices, whether it be the Russell 2000 index, the spiders, whatever it may be, every time you get an uptick on that long position, what I would suggest you do is you trail your stop and keep that stop very, very tight to maybe a previous low or a key roll reversal support level, whatever it might be. Make sure you're keeping a stop very, very tight. Okay, let's look at the diamonds. What's that? That's DIA. That is the Dow Jones Industrial Average ETF. Again, my line from the market report from last week is still in place here. We are at an area of resistance. I'm not going to draw a line up here because I like to keep my lines so that when I report next Friday, I'll still have these lines. So I don't like to mess with the lines too much, but I'll give you an idea of what I'm looking at here. This is a resistance high over the past 4 or 5 trading days, actually 6 trading days. And you'll know the high for each day is very close to what we saw in the previous day. So this is an area of resistance right here for the Dow, right around 189.39. So that's Dow, 18,900 and change. And so we have a resistance area that was reached today on the high. And again, look at the volume. This is this volume down here. I'll zoom in so you can see this. Today's volume was about 20% less than the volume we saw on Friday. So the volume continues to be in a downward slope, and when you see that, this is a stalling pattern. Again, that means the buyers are losing some of that momentum. Again, we have a gap down below the market. Remember, we saw that in the Russell 2000. We're seeing it in the diamonds, and guess what? Look at the spiders. You'll see same thing. We have a gap below the market, and we have the forecast trend. Okay, let's go to the Qs. QQQ, so NASDAQ market. Look at my lines. Isn't that amazing? This resistance line is what I drew last Friday, so we're right at that resistance point. And well, that volume is a little bit higher. And let me talk a little bit about the Qs. Even though I have a forecast for lower prices by the end of this week, I want to talk briefly about what's called the January effect. How many of you have heard that? Raise your hands. Let me see. We have anybody? We have, let me see if I could see a show of hands. If anyone wants to raise their hand, go right ahead. The January effect is when you have money managers, fund managers, hedge fund managers in particular. What happens is they start selling the large cap stocks in December, and a lot of the money managers that get paid their bonuses are paid on realized profits. They don't get paid on profits that are marked to the market. They have to actually realize the profit. They take the profit. So think about this for a second. If you've been long Dow stocks, I'll go back to the Dow and then go back to the Qs. If you've been long Dow stocks and you see that we're on a high right here, look at the weekly chart. This is the ultimate high for the diamonds, and you're a mutual fund manager, or a hedge fund manager, I should say, and you want to get paid your bonus, what are you going to do? You're going to take your profits. And taking a profit means selling out of a long position, which in turn generally pushes the Dow stocks, or the large cap stocks, down at the very end of the year. Now what we're seeing now is more or less a Santa Claus rally up into the holiday month, but when you get to the very last week of December, you're going to see pressure on the large cap stocks as the hedge fund managers and the money managers start taking their profits. That will ultimately push the price of the market down. And then what happens is they take that money after they've taken their profits in the large cap stocks, and they start putting their money into the small cap stocks, which are generally the NASDAQ stocks. Let me get the Qs up here now. So what happens is you see a rolling into the small cap stocks. So the January effect will generally be bullish for the small cap stocks, but bearish for the large cap stocks. Okay? Now, I know I'm flipping back and forth, but it's very important that you understand the cycles here, because this really is a cycle that you can count on. Let me go to a monthly chart, and I want to show you something. Actually, I could go to the weekly chart. It'll be a little bit easier to see. Let's go to the weekly chart. Look at what happens usually at the beginning of every year. I will put my timelines on, and then I'll take my timelines off. But look at the beginning of the year, or right before the beginning of each year. Look at this. Here's December, last week of December, first week of January. Look at right here. You see the last week of December, first week of January, right there. Look, going back into 2014, last week of December, first week of January. Look, these are timelines. See, these are evenly spaced right here on the calendar. Look at the cycle. End of December, beginning of January, sell-off. Right here, 2015. End of 2015, beginning into the new year, or excuse me, end of 14 into 15, sell-off. Look at what happened end of 15 into 16, boom, sell-off. So where does that leave our timeline? Look, I'm going to put the line right there. Boom. Here's the last week of December right there. You see this? So we could very well hover, maybe come down just a little bit, but I'm expecting when we hit this timeline, we're going to see the repeat of the cycle that we've seen year after year after year. If I went back for 10 years, you're still going to see the same cycle. Again, this is the January effect, hitting of the large caps, rallying more into the first 3 months of the small caps, and you can count on this cycle. So again, this is evidence, this is technical analysis at its finest, where you're able to look at the chart, and with accuracy and with our help, you'll be able to forecast the markets. Now I have to remove these lines, like I said. I like to keep my lines from the previous reports so that I have a good base to follow. Okay, let me get rid of that, remove drawing, and get that timeline out of there. Sorry about that. Let me get that in, and one more, get that out. All right, I'm going to leave that. I'll cancel that later. All right, now, I don't think I talked about this in the last week's report because I think I ran out of time. That video went for about 8 minutes. This is the VIX, VIX. Now, if anyone wants to jump in there, what is the VIX do for us as traders? What does the VIX have to do as far as it being a tool for us? How do we use it? Who wants to answer that? Mark, I'll get to your question here in a moment. Okay, Gil says it's a leading indicator. That is correct. That is correct. Greg says it's a volatility index. Amalia says it's inverse to the market. Okay, you're very, very close. The volatility index is inversely related to which market? Who wants to? Okay, there we go. Larry says it. It's opposite to the S&P. It's contrarian. Greg, you're correct. And Stuart, you are also correct. It is inversely related to the S&P. Now, I'm going to draw my price level, and I'm going to try to connect as many of these lows as I possibly can. And let's see, I'm going to go here, to here, to here, to here, right in here. You see how I connected all these lows? The volatility index, this is a 3-year weekly chart. Volatility index has an incredibly strong support level right around 11.11 to 11.5. If I go back and look at the monthly chart, you'll see that I could probably go back 20 years and you'll see that even back in 2005, 6, and 7, that level was tested right around $11 and it held. Now, if I was to superimpose or overlay the S&P 500 on this chart of the VIX, you would see that the lows would correspond to the S&P highs. Look, 2007, right before the 2008 crash, what happened? The VIX was on the low, right around $11. Notice what we see right here. This volatility index is showing a long shadow above. Now, again, this is a monthly chart. We still have a couple more weeks left here in this month. But you're going to see, most likely, you're going to see that the VIX is going to start to bounce and go higher. Let me draw my line. Let me get rid of this line right here. And I'm going to, hold on, remove that drawing. And what I'm going to say is we might see a little bit of a drop. Oh, let me get my other trend line. Hold on. Sorry. Hit the wrong line. All right. We might see a little bit more of a drop in the VIX, but ultimately I'm forecasting that the VIX is going to start to go up and possibly test this resistance level right around 23. Now think about this. We had a few weeks, actually a couple of months ago, we took a position in the volatility index through VXX. We took a volatility play in SPXS. And for the option traders, we basically bought a hedge position. It's like a lottery ticket that's being funded by other profits that we've made in other trades. For the option traders in particular, we've had an incredible run, especially with Baidu. We've made a lot of money with Baidu in a short period of time. So if you are in the Baidu trade with us, you basically earmark some of those profits to pay for hedge positions in the volatility index. Why? Because if the market comes down and comes down hard, the VIX and other volatility index like the Russell 2000 volatility index, you're going to see them start to rally. And when these start to rally, we will make money in those long positions. Now remember what I said, lottery ticket. I'm not expecting to make money in that. It's a hedge. I'm expecting to make money in all the other trades that we make. And for those who just took a position with us with the equity oracle, what did I do? We bought in CORN. We bought into CORN. Look at what's happened since that alert went out. We've rallied, and I talked about the rubber band effect and how that price does not like to stay that far below the moving average. And when that trade alert went out, hopefully all of you who are subscribers bought the CORN and you're already making money. Now, we're not quite up $1 in that trade yet, but look at the volume. Look, can you see that? Look at the bottom of the chart. I get excited about this because, again, this is technical analysis at its finest. We had a big increase in volume, probably 300% of the volume that we had last Friday, and we now have a closing price above the 20-period moving average. That's bullish. That's very bullish. So congratulations to all of you who took that position. For those of you that didn't join us on that trade, don't worry. Use it as a lesson and get in on the next trade. That's the whole point of our Trade Alert service, is to provide you with trade candidates so that every week you'll have another one to look at. You know, I'm also guilty of this. Sometimes I kick myself for not doing a trade that I could have, should have, and would have done had things been a little bit different, but we can't live in the past. Look at the signals, brush yourself off, get right back in, look for a technical signal that you can count on, and things will move along with you. Remember, you don't have to be 100% right in your picks. If you follow along with the market guys, I'm betting that you're going to be about 70 to 75% accurate in your forecasting by looking at the charts. And I'm being conservative with that. Many of you have 80, 85 and more percentage of accuracy. We're currently tracking over 90% accuracy just using these charts. Now, let me get back to Mark's question. Mark had a question, do the funds have to worry about wash sales? No. The funds, especially hedge fund managers, hedge funds play the markets. Many of them play the market long and short. And I also know fund managers who trade different strategies like pairs trading. If you've ever heard about pairs trading, that's when you go long one stock and short another. These are stocks that have an inverse relationship to each other, and you'll find that that is a very, very profitable way to trade as well. Maybe next open house I'll get into the pairs trading so you could understand how that works. It's a very conservative way to go. It's not too risky because you're hedging yourself one stock against the other, and it's also a lot of fun because you're using the charts. Okay, that is my market recap with the volatility index included. Who would like to be the first one to put in a stock? And Ron is first to post. For those of you who are Canadian, please, I'm only looking at the U.S. stocks tonight because this particular platform does not give me the Canadian one. So hopefully PAGP is Plains Group Holdings. And Ron is looking for an entry point. Okay. Well, you know, Ron, this does not look like a bad entry point, but the only thing that's holding me back on this one is look what happened today. The stock gapped up. And, you know, when I'm long a stock or I'm looking to get long a stock, I really don't like to see the gaps to the upside because chances are this stock is going to come back to fill the gap eventually before going higher. So the rally in this one today, Ron, was a very respectable one. It's up $1.79. So that's, what is that, about 5%, almost 6% today alone. But look at the volume. See, that's not a convincing breakout or a convincing signal that tells me that the buyers are just racing to market. This actually might go a little bit higher tomorrow because we closed on the high, but ultimately you have a resistance point right here. So this resistance point is going to be the ceiling that you're going to butt your head up against, and you only have about another $1 to the upside before that resistance is hit. I'd rather see a bounce off of a support without any resistance in the way or a breakout over that high. So, Ron, what I would say is be patient, wait for that gap to fill, wait for a bounce off of the gap fill point, and then an increase in volume. That's point number one. Point number two, the only other place that I would want to get long is a breakout of that ultimate high into new high territory on higher volume. Those are the 2 points that I would get long, a gap fill support level bounce, or a breakout over the ultimate high. Okay, let's see who else is next. David, what is that? I'm just reading your notes, David. That CVS, I've been selling premium since the stock was in the 50s and was put to stock at 105 on its way down. Okay, let's see. Let's look at CVS. CVS, this one actually is showing signs of weakening sell pressure. All right, so David, pay very close attention here. This gap is going to work opposite from what we saw on the other stock, on PAGP. We have a gap here above the market. We have a gap above the market here. And we see that there's a price divergence from the moving average. So this price is stretched quite a ways below that moving average. Now, this technically is a bullish engulfing pattern here. So if you are looking at the chart, all signals to me at this particular point are calling for a projection back up to 79. That's where I think the stock will ultimately wind up, with a resistance point at the gap fill right around 81.5. So I would say that you have some upside potential, but this resistance point is going to get in the way, and it's probably going to keep this stock in a trading range once that hits. Because here's why. Back up a little bit, hit the rewind button, and remember what I said when we were looking at the overall markets. I'm expecting the markets to fall last week of December and into January. So if you have a stock like this that's basically going to trade in sympathy with the general markets, you might see a little bit of a rally here, but I'm not really too excited about thinking about taking any long positions into the end of the year. Long term, that is. That's long-term positions, because of the pattern we saw with the diamonds in that cycle of selling. So if you want to buy something long, you might want to look into the contra funds. Look into gold, look into silver, look into anything that works opposite or is inversely related to the Dow or the major indices. That's going to put you in safer ground when you're trading, especially if you're an option trader. The option traders, we're looking to take on more credit call spreads or diagonal put spreads. We're looking to capture premium that will put us on the bearish side of the market. So keep your eye on your mailbox, option traders, especially those who are subscribers, because I'm going to be looking for candidates that are going to help us make money on the way down. Now, with that said, Phil is coming into here. He says, I thought OWM was a symbol. Sorry about that, Phil. Oracle, ORCL. Phil is long 1,000 shares, and let me get the symbol there right, Oracle. And let me see, you're long at $39. Ooh, okay. Well, the good news is you're up a little bit, and you wrote covered calls at 39. I think that is a great way to go, Phil. That's a great way to go. Again, for those who are equity traders, let me just give you a brief explanation of what a covered call is. And I'm going to use Phil as the example. Phil owns the stock right around here. He owns it. I'm going to draw a line right here. So Phil owns the stock, and Phil believes that the stock might drop a little bit. So what he did is he sold the right to sell his stock at the place where he bought it. So in other words, he bought it at 39, but he's willing to sell it at his buy price, even though the stock is trading higher. So what happened is Phil actually got paid $1.15 to sell it lower. So if Phil winds up selling his stock at 39, where is he actually selling it? Remember, he got paid $1.15 to sell it at 39. So he'll have an exit strategy right around $40.15, which is right around here. Now, Phil, I think that the stock is going to drop. I think it's going to come right back down. Why? It's not because I'm clairvoyant or anything like that. The main reason is I'm seeing this long shadow above the red candle. This gap has now filled. Let's see here. Let me remove this line. This gap has filled. 80% of the time when a gap fills, after the gap fills, the price will reverse and go lower. So here we are. It filled. There's an 80% chance it's going to drop. That's number one. The other part of the story is look at the volume. Look at that. Volume is dropping here. That's a sign that the buyers are getting tired. So Phil, I like your idea. Remember, if you are still long the stock, if it drops down below that moving average, you're now going to have downside risk. So be careful of that. Be very, very careful. If in December you wind up not selling the stock because maybe it dropped lower, I would sell in the money calls in January and take in another big credit to lower your cost basis. I think that would be the best bet for you. Okay, thank you for that. Appreciate it. Now, Mike, UNG, that's a stock we've seen. United States Natural Gas Fund. UNG has gapped up 2 days in a row. Now, let me explain this for you. I'm going to take this one step. By the way, Mike has a long position at $7.43. So, Mike, you are in the money now. You are faced with an unrealized profit. What I would say, and please take good notes on this, the volume is increasing right now, and it looks to me like this stock wants to fill this gap right here. Here's what you need to do, Mike. If on any day, whether it be tomorrow or the day after, if you see a drop in volume down here, I would put your stop right below the previous day's low. So follow me along here, because this is called trailing the stop. Let's say that tomorrow the stock gaps up again and the candle looks something like this. If you see lower volume down here, then what you do is you put your stop below this low right there. If the stock goes up again, then you move your stop up to this day's low. I am expecting this stock to drop to fill these gaps. I'm expecting this gap to fill right here. So you definitely want to protect your profits. And doing it manually, you can do that. It's called the manual trailing the stop. So you're physically going into your computer and to your trading platform, and you're moving your stop. Remember, you're putting it below the low of the previous trading day. Now, step 3, if on any one of these days for the rest of this week or any day that follows, you see a negative candle, let's say it's an inverted hammer, or you see a doji, or you see a bearish engulfing pattern, if you see a very well-pronounced sell signal on the charts, I would say don't place a stop. Just get out, take your profit, and run. Listen, I say this over and over again, you can't lose money taking profits. So if you see any kind of a negative signal, especially a doji, because dojis are usually found like the spinning tops, they're usually found at pivot points. Here's a spinning top up here. Here's another spinning top. You see these very small candles. That's usually a sign of the buyers having an indecision, and the sellers usually come in after that. All right, Jack. Welcome, Jack. Jack is long XLF. Let's take a look. And I don't know what you mean by that buy at market if you're already long, but let's take a look at XLF for Jack. XLF. All right, this is another. Actually, you know, Mike, you can take notes because this is exactly what I'd be looking for. This is very close to a hanging man. This is a spinning top. Now, Jack, if you're long XLF, there's a very good chance this is going to drop to here. And again, if all of you would like to take a screenshot of my chart right now, go ahead, copy it. If you want to do Control-Alt print screen for the PC users, if you want to do a Shift, I think it's Shift Command F4, Shift F4, or Command F4 for the Mac users, I would take a screenshot of this. Please do this. This is a great lesson, whether you're trading this or not. There's my forecast. I believe that's what's going to happen with this stock. Why? Because these are the telltale signs of sellers starting to come in. They're signs of indecision on the buy side, but here's the main signal. Look at that drop in volume. This is where a stock is going up, but the gas pedal is being let up on. There's a very good chance that stock's going to drop. And if you look at the divergence, and folks, if you are new to the Market Guys, I'm going to bring you to a website. Go to the Market Guys website, click on the video link right here, and watch second row, second one to the right. Watch the rubber band effect. Watch this video, because that is exactly what we're seeing. Imagine the rubber band with one end connected to the moving average, the other end to the price. What are we seeing right here? The rubber band is getting stretched. If you look back at the stock, it does not like staying that far above the moving average. It doesn't even like going that far below the moving average before snapping back to the moving average. See, so the rubber band is getting stretched. Jack is long the stock. There's signs of sellers starting to move in. I would take the profits and run. Now, Jack, you're probably making money on this. I don't know what cost basis you have per share, but if it's right near the highs, you got to be making money on that, right? I hope so. Okay, Connie, what's this? MNT.U. I don't know if that's MNT. What is that one? .U. I think that might be a Canadian stock. All right, that doesn't come up. Do you have another symbol for me, Connie? I'm only getting the U.S. stocks. So let me go to Sal. Connie, you work on that. TWM. Sal is looking to buy. Oh, I don't know, Sal. This one is, well, actually, here's what you do. This is, remember what I said about the Russell 2000. That's a stale green light. This is a stale red light. What you need to do, Sal, is on the next green candle, that's when I would buy it. On the next green candle. There's a good chance, because this is inversely related to the Russell 2000, there's a good chance this one's going to go right to the moving average. Now, that is a very, very impressive profit opportunity here, because if it just gets back to the moving average, you're talking that's a 16% return. Is that 16%? Yeah, that would be a 16% return just getting back to the moving average. So I like Sal's idea because he is taking a long position in something that's inversely related to the market. And that's what the ultra short Russell 2000 TWM is. Now, Sal, I want to help you with the stop level, because with every buy opportunity, you have to say, where would I get out? Well, there is no support. You see this? So what I would do is I would put a stop $1 below your buy price. So whenever you see that green candle, let's say the green candle shows up at 26, put your stop at 25, and then follow the 1% rule for managing risk. Let me go to the videotapes for the new folks. If you do not know what the 1% rule is, right there, go to the video page and click on that video. I think it's 7 minutes long. That talks about the 1% rule for managing risk. It's basically how to take a simple math formula and use it to limit your risk. When you can limit your risk, what happens? Your stress levels are lowered. You could sleep at night like Paul Farley. You could become more accurate because now you're allowing yourself to be wrong more often than you usually were, because you're losing very, very little when you're wrong, and that preserves your capital. So, Sal, make sure that you use the 1% rule. Okay, moving right along. We had a bunch of people log in right after I started, so welcome, folks. You didn't hear the intro, but this is really a lot of fun because, like we just saw with Sal, see, for some of you, you might be looking for a candidate, and we just talked about it. You can make your decision based on what you're seeing on the charts. I don't need to be there telling you what to do. You can make those decisions, and knowing now how to manage your risk makes life a little bit easier, right? All right, now Roger has bought STON, and Roger, if you could you tell me where you bought that? Okay, let's. I'm going to wait for Roger and see, because if you bought it around 8, you're a hero. If you bought it recently, you're still in good shape. All right, so you bought it at 9.5. It's trading 10.32. Okay, let's stick with this one. Let's stick with Roger here. Now, this I know very little about what this limited partnership does. I don't really care at this point because I'm analyzing from the charts. I'm not using fundamental analysis right now. Roger is already in it, so there's no point in us analyzing the fundamentals, because by the time they come out with their next research report, a month has passed and Roger could have already taken his profits. What I'm seeing is a very strong signal of buying activity. We're seeing 2 lows. Here's the ultimate support. That's a bullish engulfing pattern right there at the very low. There's a bullish engulfing pattern. And if I connect that low to this low, we are now in a short-term upward reversal of the trend. This is catastrophic news. I'm not even going to say that this gap is going to fill right away, because chances are it will not. What will most likely happen when you have big downturn in a stock like you see here, usually what you see is the stock will start to trade in a channel. So this trend could continue all the way up to this point and then come back down. This creates a trading opportunity for anyone interested in trading a channel stock. Okay, so Roger, if you bought this, you absolutely need to protect your profits while you have them, because this stock, if it gets up to that moving average, it come right back down and give your profits back before going higher to test that resistance. So I like the fact that you're in it. I would stay in it, and what I would look for actually is another strong green candle on higher volume. Sorry, I hit the wrong button. Let me go in. I would not be opposed to you adding to the position on the way up, believe it or not. If you see a green candle here and the green is on higher volume, that means the buyers are seeking bargain level prices and they're building confidence back into the position. So right there, that's a good position for you. Just make sure you put your stop somewhere below 8, which is that low right there. All right, Bruce, you almost read my mind, because HSY, ready? Here we go. HSY historically is a cycle that I recommend. It's a cycle stock. Hershey Chocolate is a very, very big cycle stock. Most of the time, and I'm saying most, and I'll go back to the weekly chart so you can see this. If you bought this stock, look at the last 3 years. I'm using a weekly chart. If you bought this stock in December, actually November, December, look, here's November, December, you would have made money. If you bought it back here, November, December, you would have made money. If you bought it back here, right here, November, December, this is right here, November, December, you would have made money. Now, this, again, is a very good trading candidate. Now, it's not for anyone because it's a fairly expensive stock, right? It's trading just under $100. So not everyone's going to be able to buy this. But if you have enough money and you want to buy something, my projection, even if the market goes down, even if the market goes down, this is still a good long position because the holiday season drives chocolate prices. People are baking, people are eating. You had Halloween just last month, and the profits haven't shown yet for that season. They'll report that probably the next quarterly earnings, and you have all of that feeding into another cycle. Now, for the option traders, I'm giving my hand away here. This might be a great put spread, a credit put spread. Or if you want to do a diagonal calendar call spread, you can do things like that. In fact, what I'll do next week, I'm good, because of Thanksgiving, I'm not putting one out before the holiday. I might put one out on Friday for the following week, so stand by for that. I might actually consider Hershey as the candidate, but don't do anything until I lay that out for you with all the risk points. Okay? Now, Chris does not have a position in Tesla, but TSLA has had some volatility lately, mostly to the downside. And so if you look, I'm going to go to the weekly chart. Tesla has some support right here. Let me erase these lines. Let me get rid of these lines because we were talking about a credit put spread in Tesla not too long ago. All right. This one has been in a downward trading channel. You see this? And so this trading channel is still in a downward slope. And the 20-period moving average is still going lower, and the price is still below the 20-period moving average. So, Chris, I feel very comfortable in telling you, look for another candidate. You got too many odds stacked against you to be taking such a long position, and plus, this is a large cap stock. Remember what I said about the January effect? The money managers are going to be selling the large cap stocks, which is only going to put pressure on Tesla. That's my forecast for Tesla right there. I think you're going to see a downturn from that 20-period moving average, and the only support level is going to be right here. I know that's a dramatic pullback to that trend line or that channel line, but that's where it could wind up, 150 to 160. I would say look for another candidate. Okay, Ann, looking at Facebook. Now, the good news for you, Ann, is that Twitter is making very, very big mistakes. Twitter, I don't know why they would do this, but there were two companies recently that made big mistakes. One was Twitter, and one was Pepsi-Cola. I don't know if you're following the news, and it does not matter what political flag you fly. Whenever you make a political comment as a CEO of a company or take action in any political way, you're going to alienate 50% of your subscribers or buyers. People have not figured this one out yet. I don't understand. In an interview last week, it was right after the elections, the CEO of Pepsi made a comment, a political comment, and immediately there was a boycott launched against Pepsi-Cola. Well, guess what? Facebook is going to benefit from that because Twitter also took a political stance, started suspending conservative accounts. They had class action suits. I don't know if you're following this, but they had class action suits filed against them for violation of First Amendment rights, and they're a publicly held company. You don't do that. You owe it to your shareholders to remain neutral. Even if you have a strong opinion politically, you owe it to your shareholders because you don't know what your shareholders' views are politically. And big mistakes. I cannot believe that these CEOs are making such rookie mistakes. Very, very bad. So Ann, you bought it at 112, and I would say hold it. Here's why. Look, by the way, we analyzed Facebook, and this was the channel line. Isn't this interesting? Look at how that channel line held. And so there's a gap above the market. Let me get rid of this line, and I'll clean it up for you. I'll leave the channel lines up for Ann, and then I'll tell you when to get ready to take a screenshot. Okay? Take a look at the volume. Can you see this? Look at the volume. Volume right there is 20% higher than it was on Friday. This is a major green candle. That means The buyers are putting the pedal to the metal. They are accelerating their buying activity. Volume is up. There's a good chance that Facebook is going to go higher, and I'm going to put a short-term target right around 126 to fill that gap. Now, Ann, if you bought it at 112, please do something to protect it. Look at the charts. You cannot even relax one day while the markets are open, especially if you don't have any stops in place. You cannot just put that aside and think, okay, next week I'm going to take my profits. Facebook could drop as quickly as it did back here, back in October, where it was trading right around 134. It could go from 134 to 114 and drop 20 points in a matter of weeks. It could do that. It's highly volatile. If you have a profit, again, what I said earlier is every single time, if you see a drop in volume at any point in time after tonight, if you see a drop in volume, you have to put your stop below the previous day, or if you want to be a little bit more aggressive, put your stop beneath the low of that day you're looking at the chart. Remember, this is a shortened trading week. We're going to have volatility because people are squeezing in their charts because the market's going to be closed for Thanksgiving. So they're going to squeeze in the volume, and that's going to increase the volatility. So, Ann, I like your position. Congratulations. Protect it. Watch the charts. And don't be afraid to at least take half your profits up here when that gap fills. Because 80% of the time after a gap fills, it reverses and goes the other way. And that is what actually could happen with Facebook right there. All right, let's see. Ken is GILD. Is that Gilead Sciences, I think? Let's see. GILD. Yes, it is. Gilead Sciences. Oh, Ken, this is good because it's an inverse head and shoulders pattern, number one. Let's make a checklist for Ken. Okay? We're going to make a checklist for Ken, and that checklist can be applied to all of you who are looking at stocks. We first look at the price action. What do we see? The price action is down. Okay? So that's a down leg. Also, we see that the volume is down. So we're looking at price, we're looking at volume. Okay, here's the test question, everyone. When the price is going down and the volume is going down, is that bullish or bearish? Who wants to be the first to answer? 1, 2, 3. Wow. Gil, first. Sal, buying those. Second. Robert, coming in at a length. And David, right in there. You're all right. That is bullish. Oh, Robert, you put bearish. It's bullish. When the price is going down and the volume is dropping, that means the sellers are running out of stock to sell. Think about this for a second, everybody. Imagine all of you have Gilead Sciences in your portfolio. And it's been going down, and you sell it, and you keep selling it, and you keep selling it. What are you going to do when you sold all your stock? You have nothing left to sell. And that's what happens with the community of investors who own Gilead Sciences. If they've been selling, they're sold out. So the volume is going to reflect that. The volume is dropping, telling us the sellers are slowing. That is bullish. That's bullish. So I think it could go right back up here. That's point number 2. Now, who could tell me what this 2-day pattern is? A small green candle that falls within the body of the previous red candle. Who has been doing their technical analysis homework? Who could tell me what that is? Give you a hint. Starts with an H. Nathan, you got it right, but there it is. Gil, again, Ken, Lloyd, Diane, Larry, it's a pregnant candle. Japanese term for that is harami. Harami. A harami is a very bullish 2-day pattern that is as bullish as what we see down here. This is a bullish engulfing pattern. It's a big green candle engulfing the previous red candle, or small body falling within the red candle. These are both very bullish signs, very bullish. There's an 85 to 90% chance the stock is going to go up tomorrow, so be careful. Don't just sell the house, sell the kids to get long the stock. You got to make sure that you are putting in your stop. Okay, so Ken, you're looking for an entry point. That's probably as good as it gets right there. All right, so if you get long the stock tomorrow, put your stop right below that low. Boom, put it right there. So if you buy it at 75, you're putting your stop roughly $1 below your entry point. Okay, Nicole, boy, I'm losing my breath here trying to keep up with all of you. Okay, Nicole says GE. Nicole bought it at $29.88. This is General Electric. It's very much like a mutual fund, actually. You bought it at $29.88. Congratulations, you're up. But look what's happening. Can you see that right there? I'm gonna put in a horizontal line. I want to show you the price level. I'm going to mark the filling of that gap right there. Friday and today, that gap is filled. That's number one. 80% of the chance after a gap fills, it drops. So, Nicole, I wouldn't be so opposed to selling half the position because there's a good chance it's going to do that. Take a screenshot, folks. I don't want you to just take my word for this. I want you to see the evidence and how this plays out. So Nicole is up. She's profitable. She wants to protect the profit. It's filled the gap. It's a good chance it could drop. There's also a very, very minor gap right here. Let me see. The high from this day was $29.81. The low from this day was $29.83. There's an actual 2-cent gap right there. So there's a chance that the stock is going to pull back to that gap before going higher. So it could do this. It could do just like that. Okay? Notice the price has been going up. The volume has been going down. That's, again, price-volume divergence. When the price is going up and the volume is dropping, the buyers are running out of money. Remember, in the last example, the sellers were running out of stock. On the upside, when you see the volume drop, the buyers are running out of money. So when they run out of money, they can't buy any more stock. Sellers recognize that. Bam, they come in, they hit it, take profits, and they move on. I have time for one more. Hendra, I'm not going to be able to get all of your stocks, but I'm going to look at NVIDIA, because that's first on the list. NVIDIA, I would have a very hard time buying this because you got resistance up there. You got a wide divergence from the moving average. You got a gap below the market that's most likely going to fill. And you got the drop in volume, which is telling us that the buyers are running out of money. I don't like anything about a long position in that. I would abandon it. So not to leave you hanging, I'll go on to the next one to see if we can find something better. Remember, I don't like the idea of taking long positions right at the very end of the year because of that January sell-off. I'm telling you, folks, look for something that you can feel comfortable with. I don't see anything here, Hendra, because you got resistance right there, and you got an increase in volume on the red candle. That's telling us that the sellers are getting excited. I'm going to try one more time. CRM. Let's see. CRM, Salesforce. This one, at least as a candidate. Salesforce is something you might want to look at. Why? Because, look, the gap is going to fill, but don't buy it until the gap fills. Once the gap fills, there's an 80% chance it's going to reverse and then go higher. So what you have to do, wait for the gap to fill, wait for a green candle, buy on the green candle, put your stop below 72, and trail it as the price goes up. Whoa, I'm going to have to go get my oxygen now so I could breathe. Folks, I want to tell you something. Thanksgiving is my most favorite holiday of the year. And the reason for that is because it gives me a chance to look back at the year and reflect and, again, be thankful for all the things that we've been blessed with. I am truly thankful for each and every one of you, and I mean that sincerely. If it weren't for you and those who follow the market, guys, Bill Shanley, my partner, and I would have no work to do in the market. We'd be talking to each other, analyzing charts, and trading our own accounts, most likely. But it gives me great pleasure, if you haven't picked up on this already, it gives me great pleasure to teach people how not just to make money in the market, but how to take that money and go out into the world and do good things with it. If you're like me and you've been blessed in your life to have the great fortune of friends, family, and a good career and good trading activity, then please, once you've taken care of yourself and your family, go out there and find some good things to do with that money you've made. Make a difference in the world so that other people could be thankful for you. So with that, it's 9 o'clock right straight up. Again, happy Thanksgiving. We'll talk to you next time. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.